All right. Hello, everyone. I think some of you are still joining, so thanks for joining today. Welcome to Consensus Conference 2025, What the Numbers Tell Us. My name is Kristen Noner. I am a lobbyist here with Kelly Cawthorn. And if you're joining this webinar today, you likely know that the most recent May Consensus Revenue Estimating Conference happened on May 16th. We learned a lot about the state of the US and Michigan economies and what our state leaders have to work with in terms of revenue as they shape the fiscal year 26 budget. But we also learned there's a lot we don't know or is uncertain. I had the privilege of doing the KC Ask the Expert series on the CREC, which you can check out on our website. But here today is a real expert that I'm excited to introduce, Ben Gilchek. Ben serves as an associate director at the Michigan House Fiscal Agency, where he brings over 17 years of experience providing nonpartisan fiscal and economic analysis to the Michigan House of Representatives. His expertise spans economic and revenue forecasting, tax policy, economic development, local government finance, and retirement systems. Ben holds a BA in economics and political science from Hope College, JD from the Indiana University Robert H. McKinney School of Law. Before joining the House Fiscal Agency in 2008, Ben worked in regulatory oversight at the Chicago Board of Trade. So that's an impressive background. And with that, I will hand it over to Ben.
Thanks, Kristen. So I plan to spend the next 30 minutes or so walking through a brief picture of the economy and then end with our current outlook for state revenues based on last month's May Consensus Revenue Estimating Conference. So let's just start with an economic update. I don't think it'll be a surprise to anyone. I think Kristen even noted the word, but I believe one word to best describe the current economic moment is uncertainty. You can't read a newspaper without reading it multiple times. The shifting and uncertain policies around tariffs and trade, immigration, the federal budget, and tax policy have generally increased the distribution of possible outcomes, possible economic outcomes, I should say, with those outcomes generally weighted to the downside currently. The more uncertainty there is, certainly the lower confidence in forecasting the future, meaning our assumptions are quite a bit less reliable when what we assumed at a given point in time could change pretty substantially even in the short term. Short term, something we like to think we have a decent handle on, and I'm not so certain that is the case today. Policy, especially around tariffs, has been changing pretty rapidly week to week and even day to day. So that is all to say, I think a baseline forecast is certainly less reliable in this environment. If you were to weight your baseline high and low scenarios, you might give the baseline normally a 50 to 60% probability. However, today that baseline probability has diminished quite a bit. Here I've included a chart just to put a visual to the uncertainty discussion. This chart represents the Economic Policy Uncertainty Index developed by some researchers through news coverage usage of terms and the dispersion of disagreement among economic forecasters. You can see we recently reached some historic highs out here in the early months of this year, with the last read showing a fairly significant drop after some step backs in the tariff space. Now, certainly, while this is an imperfect and noisy chart, as you can see, I think it does help you to visualize the uncertainty that people and businesses are feeling and expressing in recent months. So you may have come across some discussions in the news about soft data and hard data, hard economic data. While it has certainly been tracked for quite some time, soft data really made a name for itself most recently during COVID because traditional economic data operates on a bit of a lag. Soft data allows us to peek under the hood on a more real-time basis, even if the information is less reliable than the traditional data points we would monitor regularly. Soft data includes things like sentiment indexes, earnings outlooks, capital expenditure and new orders outlooks, inflation expectations, and even things like TSA checkpoint data, hotel occupation rates, and restaurant reservations. Hard data, on the other hand, would include inflation rates, unemployment rates, payroll gains, housing starts, and consumer spending, to name a few. And what you'll see in some coming slides is that those have remained relatively resilient. Generally, it takes time for the hard data to catch up with the soft data, but I would also note that it doesn't always show up in the hard data, meaning the negative sentiment that I'll show you doesn't always pan out. If you go back to 2024, the word was vibe session. Consumers were expressing negative outlooks, but their actions were telling a different story. They kept spending and jobs were plentiful, wage gains were strong. So we don't know what will happen this time, but certainly the longer negative sentiment continues, I think the more self-fulfilling it can become. Now I'll just walk you through some of the soft indicators. This data can be very noisy, but I think it can provide helpful qualitative insights about the consumer, businesses, and the wider economy. So here you can see the U of M Consumer Sentiment Survey. Take it to the out point here, and you can see 4 months of declines in the Consumer Sentiment Survey starting in January. The latest read for May, which doesn't really show up in this chart, but was unchanged from the April reading at about 52, stopping the downward trajectory that we had seen for 4 months. But consumers were still expressing concern about the future and things like wage gains and inflation, despite the improved tariff outlook recently. This chart is just another look at consumer sentiment from the Conference Board. Here you can see similar trends, 5 straight months of declines. But the latest May reading saw consumer pessimism about the future moderate after the detente with China over tariffs, and improvements were seen in consumer expectations in all the components, business conditions, employment prospects, and future income. So we saw a pretty significant jump there in May. And again, this, like I said, this information can be quite jumpy. So taking one reading is not always, you kind of got to look at trends here. Here's a view of CEO confidence. This comprises an outlook on business conditions, sales, hiring, and general economic conditions. A reading below 50, sort of this yellow dash mark, reflects more negative than positive responses. Here you can see the index of CEO confidence updated quarterly fell in Q2 of 2025 to its lowest level since 2022 Q4. More than half of CEOs surveyed expected business conditions to worsen over the next 6 months, and over 80% said they expect a recession in the next 12 to 18 months, which almost matched the number from late 2022. What I will note is that we didn't experience a recession back in 2022 or 2023, so this is a good reminder that soft data doesn't always show up in the hard data. I referenced this earlier. Here you can see consumer expectation about inflation 1 year from now, and you can see it rising quite steeply over the past few months. The median expected price change in the next 12 months is currently at 6.5% in the May read out here, and that's been climbing, which matched the 6.5% from the April report. I will note, and I didn't show it here, and I don't have a slide showing it, but the Conference Board has a nice chart showing inflation expectations versus reality, sort of the comparison. And a consistent theme is that expectations usually exceed reality. However, that doesn't mean expectations don't change people's actions, especially expectations that remain sticky. I think if I threw another set of slides in here showing capital expenditure plans, earnings outlooks, and job loss concerns, those are all starting to trend more negative, similar to these charts that I've shown you. Moving on to some hard data indicators, as I noted, the common theme will be that much of the recent negativity in the sentiment indicators has not shown up in the hard data. Here is inflation, both at a headline and a core perspective. This continues to trend downward in the recent readings. You can see out here, both trending, the headline inflation now at about 2.3%. Both the last 2 months readings came in below consensus estimates. While we haven't seen a tariff impact in the inflation data yet, there is a general feeling that some of the tariff impact doesn't start flowing through until the summer months due to retailers still working through their inventories. The flip side of the decline in inflation is that interest rates, think things like treasuries, mortgages, other consumer and business credit, remain elevated and sticky. How this impacts things like the purchasing of new homes and business investment remains to be seen in future months, but it will certainly put downward pressure on spending and investment the longer rates remain elevated. This slide shows monthly payroll gains. You can see that going back to January 23, right about here, if you can see my cursor, they've remained fairly steady around the 200,000 number, which is a good spot to be in for an economy on trend. I wouldn't highlight these numbers out here. This is coming out of COVID, and you see some pretty significant payroll gains, but around the 200,000 number would be pretty on point. The next read we'll have for this is tomorrow morning, and the consensus is for about 130,000, so which would be a slowdown, but not certainly a terrible number. And this can be a little bouncy. So certainly more, you kind of want to look at a trend than you do at one single number. A couple of other employment markers I would note: job openings have been on a downward trend, but they still remain above pre-pandemic levels, and weekly unemployment claims are still within normal ranges. National unemployment remains low. You can see that in the blue line. here, the last reading was 4.2%, which is still quite low based on history. If you can go back to 2000, you can see that's at some historical lows. Michigan, which is represented in orange, has ticked up to the mid 5% range, which is a bit concerning. But as you can see, Michigan has historically run a bit higher than the national rate, and we aren't currently out of the sort of normal differential that you've seen at times. But it's certainly something to watch in the coming months because the trend, it has us a bit concerned, but not terribly worrying at this point. A couple other points I would make: consumer balance sheets remain okay. We are seeing some delinquency rates and the percent paying minimum on credit cards rising, but not to worrying levels yet. And consumer spending, even in the latest GDP read, has remained at decent levels. So this slide sort of summarizes the general economic outlook. The Wall Street Journal does this here on the left side. The Wall Street Journal does a quarterly survey of about 50 macroeconomic forecasters, and one of the questions has them forecast a growth path for 6 quarters. And this shows the last three results of the survey. So going back to the fall of 24. So Q4 24, the first quarter of 25, and the second quarter of 26. So October, January, and April. And if you can see this light dotted line here, this represents the average forecast from 2024. This showed strong 24 Q3 with the economy dipping below its sort of 2% longer term trend and then rising back to it by the third quarter of 25. This darker hash here represents the January 2025 average forecast. Following the election, you can see it is generally rosier with strong 2024 Q4 growth declining, but remaining above the longer term 2% growth trend throughout the forecast horizon. And then this dark line here is the latest survey from April 2025, and you can see the collective drop in growth expectations. After a few quarters of annualized quarterly growth below 1% here, it is still forecast to remain below the longer term 2% trend into the first quarter of 26. The chart on the right represents the average of survey responses to the question of what probability do you assign to a recession in the next 12 months. And you can see that number has spiked in the most recent survey to 45% from around 20% in the January survey. We haven't quite reached the high probabilities seen in 2023 when there were concerns about the Fed being behind the curve, with the Fed funds rates being held high while inflation was coming down. But I think this shows that recessionary concerns are certainly present. All that said, our consensus baseline forecast was not recessionary. We had softening growth returning to long-term trend of 2% growth by 2027. We have inflation bumping up above 3% in 2026 before decelerating back under 3% in 2027 as the economy absorbs some of the tariffs. We see the labor market softening a bit with US and Michigan unemployment rising and payroll gains stalling but not going negative. Michigan remains relatively flat on the employment front throughout our forecast horizon, meaning wage and salary jobs sort of fluctuate around the same range. Auto sales dip a bit into the 15 million range nationally, which is about 1 million below recent annual rates. So in general, looking at all the data points, our economic forecast certainly shows a slowdown, but I think we're all accepting that the spectrum of possible outcomes is wide due to current policy uncertainty. Now we'll turn to an update on revenues from MACREC. Just a couple of notes to start. General fund revenue is more prone to absorb policy changes and has more volatile and harder to forecast revenue streams. About 60% of general fund revenue is from the individual income tax, which is some volatile components. Specifically, an issue encountered at MACREC was income tax refunds were running well ahead of the forecast from January. And I will note that refunds reduced general fund revenues. The main culprit appears to be recent tax policy changes and some missed estimates on sort of the usage or how big those numbers would be, which I'll discuss in a later slide. School aid fund generally has more stable revenue sources that are more correlated with economic conditions. It also absorbs fewer tax policy changes. Here I would think of like sales and use tax exemptions where school aid fund is held harmless, or changing the school aid earmark in the income tax to ensure it doesn't realize revenue losses from things like the retirement tax changes from last session. Sales and use tax revenue makes up about 50% of the school aid fund revenues and are generally correlated to economic conditions. About 25% of the school aid fund comes from income tax revenue, but I will note here that refunds do not factor into the school aid distribution, so they're not hit by some of that volatility we've recently seen. That's just refunds only hit the general fund. And the state education tax, which is about 15% of the school aid fund, is tied to taxable values, which somewhat track nicely with inflation and housing trends. This slide just highlights some of the income tax variability we've been seeing in our revenue forecast as of May. As you may or may not know, the May CREC is designed to come after individual income tax returns are due on April 15th. It gives us a nice, robust look at what revenues are doing. As I touched on in the last slide, refunds through April look a lot larger than we were expecting. The homestead property tax credit is running ahead of estimates by about 70 million, the result of property value growth, income growth, and inflationary indexing that started in 2021 on that tax credit. And this mostly shows up in larger refunds. Something else that shows up in larger refunds is EITC filings are up about 50 million from our forecast. And then we also have about 120 million in refunds that we did not expect. And this is due to retirees who didn't change their withholding after the enactment of changes to the expansion of their retirement tax exemptions last session. Essentially, taxes are being withheld on the retirement distributions, increasing individual income tax withholding collections. And then the individuals are filing their taxes and receiving a refund for the over withholding. And while this is a net zero impact on a revenue basis, there are tweaks to the distribution as a portion of the individual income tax withholding revenue gets deposited in the school aid fund, while when they get it back on refunds, it's only hitting the general fund. Processing is also moving much quicker this year to the tune of almost 100 million in the refund category. And it's expected this will just show up in the coming months as fewer refunds for a net zero impact. Putting the refund picture together, you can see in the bar chart on the right the growth in the average refund over the last 4 tax years. It's up about 16% this year and about 50% since tax year 21. One other note, sort of on the bottom there, the last bullet on the left side, income tax annual payments are up about 100 million from our initial estimate in January. This is a little interesting because when refunds are up, annual payments are usually lower. We don't have a great grasp yet on why this might be the case, but it was certainly a surprise to the upside on our individual income tax revenues. So these next 2 slides show our correct revenue estimates over the forecast horizon. And you can see here for the current fiscal year 2025 school aid fund, we estimate to be about 18.5 billion. This was an 85.6 million revision upward from January CREC estimates and a 470 million increase over fiscal year 24. For the general fund in fiscal year 2025, you can see we estimate about 14.5 billion. We revised our January number down by 221.6 million, and that's a slight decline from fiscal year 2024 of 33 million. Going to fiscal year 2026, you can see school aid fund is 18.9 billion, a slight revision upward of 43 million, and a year-over-year increase of 389.1 million. General fund, we estimate to be 15.1 billion in fiscal year 26. That was a revision down of 363.1 million and an increase year over year of 620.7 million. I'll note here that this big increase in general fund is not due to economic conditions. You may or may not be aware of the SOAR fund. There's 600 million in earmarks. There's 500 million to the SOAR fund, 50 million to the revitalization and placemaking fund, and then 50 million to a housing fund. And 550 million of those earmarks go away at the end of fiscal year 25. So this is sort of artificially inflated. You can see it's pretty much flat if you back out the 550 million that would expire. And then in fiscal year 27, school aid fund grows to 19.4 billion, a slight revision upward of 44 million, and a year-over-year increase of 464 million. General fund comes in at about 15.3 billion. That was a revision down of just about 400 million from January and a year-over-year increase of about 229 million. This just shows you the longer term growth pattern for general fund. When I started here back in 2008, we sort of joked throughout much of the 2010s that we'd never get above a $10 billion general fund. And as you can see here, all it really took was a pandemic to really knock that number well above the $10 billion mark. And between fiscal year 2020 and fiscal year 2022, you can see that general fund has leveled up to the $14 to $15 billion range. One other thing I would note is that even with that pretty significant growth recently, you can see that when adjusted for inflation, this red line here, that general fund is still well below the fiscal year 2000 level. And before I turn to the next slide, I would just notice the bounciness in this chart. You can see, I sort of hinted at it earlier, when you compare this slide to the next, you can see the GF revenue volatility I spoke about in a couple slides back a little more clearly. The school aid fund is much smoother here, as you can see. Um, Again, the level up during COVID for school aid fund, similar to the GF chart, when adjusted for inflation, the red line shows the school aid fund is slightly above the fiscal year 2000 level, even with the strong growth of the past 5 years. I think one thing to take away from both of these slides is that the higher revenue levels we're seeing today relative to the 2010s are something we anticipate maintaining on a baseline basis, meaning barring some economic event that would, throw this out of balance. But this is just generally due to inflation and strong wage gains flowing through and raising the price level for goods and services and labor. We've experienced disinflation, but not deflation. So we expect aggregate price levels to remain where they are, leading to generally higher revenues on a nominal basis. But as the real adjusted numbers show you, the red line in both charts here, um, costs for the government are also rising, leading to fairly stagnant purchasing power. I just want to end with a look at the balance sheets for fiscal year 25 and fiscal year 26 for both the general fund and school aid fund. Here we'll start with the general fund. The current fiscal year started with a beginning balance of 2.15 billion. You can see our January CREC estimate of 14.7 billion. We revised that number in May down by 220 million. You back out revenue sharing and public trust fund, and you get total revenue available in fiscal year 25 of about 13.9 billion. And here you can see the fiscal year 25 budget sort of laid out sort of in the aggregate. Ongoing appropriations totaled 13.6 billion. One-time appropriations totaled just over about 1.26 billion. Caseload and economics adjustments upward of 234 million, and then supplementals of about 250 million. And you can see total expenditures of about 15.4 billion, leaving us with a total ending balance of in this fiscal year of 718 million. Again, carrying that forward then to next year, this is again just a baseline balance sheet. So what we're going to do is just carry forward ongoing appropriations and update revenues to associate those with May CREC. Here you can see our January CREC estimate adjusted for May. Revenue sharing and public trust fund are backed out. You get total revenue available of 14.27 billion. We carry forward those ongoing appropriations on a baseline basis. One-time appropriations are treated as one-time and backed out, so we get zero. We adjusted caseloads mainly around DHHS, Medicaid, and childcare caseloads up by 741 million. And you get total expenditures of about 14.5 billion. So you can see those are running ahead of total revenue available, and that takes down our ending balance in fiscal year 26 to about 520 million. So the general fund is, relatively tight, but certainly on a baseline basis is in balance. School aid fund balance sheet is in much better shape. You can see in fiscal year 25, we started with about 1.25 billion. You can look at your revenues for January, the May adjustment upwards, some of the other school aid fund revenues, and you get total revenues of about 21.6 billion. School aid appropriations after May CREC revisions around pupil counts totaled 20.7 billion, and then you can see the allocations of school aid fund for community colleges and higher education there of about 462 million. Total expenditures of 21.6 billion leave us with a total ending balance at the end of this current fiscal year of an estimated 1.24 billion. So then carrying that forward and looking at the 26 budget on a baseline basis, you can see factoring in the various revenues like we did with general fund. I won't walk through each step, but total revenues of about 21.4 billion. On a baseline basis, that school aid allocation drops to about 19.4 billion. Community colleges and higher education are adjusted a little bit, but maintained, and you can see appropriations totaling 20.3 billion, leaving the fiscal year 26 with an ending balance that rises to 2.3 billion from the starting balance of just above 1.2 billion. And with that, I'm happy to take any questions.
Yes, please submit questions if you have them. I see we have one. what are the quote other restricted funds on the school aid balance sheet?
I think those represent the reserve fund allocations. In prior budgets. They had set aside some funds for things like retirement and transportation that they made sort of pre-funded some reserve funds that they then used to fund items in the current fiscal year. That means they're essentially pulling those out of those reserve funds. And then you can see the reserve fund deposit. There's an additional 25 million reserve fund deposits below that. But that's, I think, what those represent is just the withdrawals of those to support expenditures.
So this is kind of a broad, open-ended question, and I know we don't yet know what is going to happen at the federal level, but could you talk a little bit about what you all are watching in terms of the budget reconciliation bill and discussions in Washington?
Yeah, I mean, the main thing that we would look at through the reconciliation bill is sort of how are the tax changes going to affect Michigan's revenue picture. And some of the things, and we had a recent discussion even around, I think around the time of CREC, as they were kind of it was working its way through the House, around will things like no taxes on tips or no taxes on overtime flow through to Michigan. And in that case, it's below sort of what we'd call below the adjusted gross income line. So in that sense, it's not going to impact, at least in its current form, not going to flow through and impact the states. But I think there's been some reporting out there how some of these things may flow through and impact the states. And as they sort of finalize development of that, that's sort of the main thing we want to look at is what changes are made that will flow through and impact our revenue picture going forward.
Another question, why has GF revenue remained relatively flat since the early 2000s?
Well, on a nominal basis, it's certainly gone up. It's when you adjust for the inflation that it's remained relatively flat. And I think what you're seeing, I kind of hinted at, general fund has taken the brunt of tax policy changes. If you remember back in 2015, 2016, there was the roads plan that took 600 million out of general fund, allocated it for roads. There have been other things along the way that have allocated general fund, and any of the tax changes have sort of, tax expenditures also impact general fund, and you've seen that bounce around. But I mean, the main thing, if you look at, yes, it's grown from around the 10 billion mark to 15 billion currently on a nominal basis. On a real basis, it's when you just adjust for the high inflation levels recently, it's held pretty flat. I would say school aid is held relatively flat too, due to those inflation numbers that have come in recently.
There's been some speculation. I have the fun questions. There's been some speculation that there could be a September CREC. Are you able to comment on that?
Yeah, I mean, I know there's certainly in an uncertain environment, there have been things thrown around that. At this point in time, I don't know. I can't say yes or no. Certainly, it's as statute goes, either of the three principals. So my boss, Marianne Cleary, Catherine Summers at Senate Fiscal Agency, or Treasurer Eubanks can call for a CREC, another CREC at some point. We had one during COVID. If things remain highly uncertain and we see in the hard data numbers start to jump, we monitor revenues on a monthly basis. If they start to come in, much higher, much lower, that kind of thing, it might necessitate the need for one. At this point, it's hard for me to make a claim about whether I foresee it happening or not.
Yeah, it kind of puts you in the hot seat on that
No,
one.
that's all right.
It's good to know that as we know, there is precedent for it. So
yes.
All right. Do we have any other questions? All right. Well, thank you, Ben. And thank you everyone for joining. This webinar will be recorded and can be located on our website. And you can also check out our website for upcoming webinars. Yes, thank you again. I hope everyone has a wonderful rest of the day.